And welcome back to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Of course, you can get all of our podcasts online at our YouTube channel as well as on our website at realinvestmentadvice.com. Just simply click on the YouTube tab. Along with our blog posts, newsletters, you can ask questions and get access to all the information that we have there. We're talking today with Teddy Vallee, and when we left off in the last segment, I said that we wanted to switch over. Let's talk about this recent interview you did with Real Vision about emerging markets. There's been a lot of conversation from analysts as of late talking about, on a relative basis to the U.S., emerging markets are really just screaming cheap. You need to have your money there. You need to be buying international stocks. And the problem is that while they have certainly had a really nice return here over the last few months, really, since the beginning of 2019. From an asset allocation basis, if I had bought emerging markets and the S&P 500 back in 2009, emerging markets have actually underperformed on a total return basis relative to the S&P 500. So when you talk about asset allocation, diversification, they're highly correlated in their moves relative to both markets. Am I really getting the bang for my buck that I am expected to get out of emerging markets? And are they really as cheap as everybody say they are?
Yeah, it's a great question. So we did a fair amount of work on this. And the reason we got there, we owned emerging markets sort of at the low for three primary reasons. One, we thought the dollar was going to go lower as China stimulated and some of the China data improved. Two, we thought they were relatively cheap, which is the view of the market right now, which on a relative basis they do look cheap, but with anything that's relative, there's two components. So there's the S&P valuation and then also the valuation of the emerging markets. So in digging into that, so it's trading at roughly 12.6 times next year's earnings, emerging markets as a whole. Okay. That's about a 40 basis point premium to the 5-year average. So you're roughly paying right now the average of the whole cycle. And what we do is with the leading indicators is we found that emerging market EPS could actually be down significantly next year, along with the global EPS and also the U.S. EPS. And right now, what's baked in the numbers is that's supposed to be up 2.6, and we think it could be down pretty materially. So right now you're paying, ostensibly it looks cheap relative to the U.S., but then you go, okay, wait a minute, well, what about, is the U.S. overvalued? If the emerging markets are trading at a roughly fair value at 5-year average, and based on optimistic numbers, well, what is the other component trading at? And we think the S&P is probably significantly overvalued. So on a valuation perspective, we couldn't really see it, and the valuation is primarily based on the earnings numbers, which analysts are forecasting based on China. So China is the big piece here that we've really dug into. And a lot of the work that we've done is based on China's credit creation. So we think that China's credit creation, or China in general, drives the whole global cycle. So it represents roughly a third of total GDP growth for the globe, which is more than Japan, Europe, and the U.S. combined. It's about 70% of Asian emerging market manufacturing, and is the largest importer of 50 countries, which is up from 5 about 10 years ago. So China is the largest driver of the cycle globally. So in breaking, and how do they do this? Well, they did this primarily through their credit creation. So in 2007, they had about $4.5 trillion of credit. That's now in excess of $34 trillion. So the amount of credit growth is astronomical, and what really drives the cycle is the rate of change of that credit growth. Right. And what we dug into are the subcomponents of that credit growth, and everyone is saying, okay, they're stimulating, the credit numbers are going to go higher, and what we're seeing on the year-over-year basis is they're not going higher yet. And that leads all the data basically around the world by about 9 months. So once that ticks higher, which is possible, we're going to get the number this week. Once that ticks higher, then in 9 months you have the economic data bottoms. So we can't see a bottom in the Chinese data for at least 9 months right now. And a lot of people and strategists are very, very optimistic on China. If you look at flows, if you look at positioning, everybody on CNBC's, we want to be long and overweight emerging markets. Every sell-side strategist is saying the same thing, and then the amount of capital that's flown into these emerging markets is on a mathematical basis, we're looking at 2.5 standard deviations on a 2-year time frame. And historically, when that's happened, you've had pretty negative returns. So right now, emerging markets to us don't look as cheap as ostensibly is the market sort of painting that picture, primarily because we don't think China is out of the woods yet. Ideally, and another point is you really need to see the dollar go lower. Some of the work that we did is we said, okay, in 2016 when things bottomed, what did the dollar do of all these exporters, of the largest exporters to China? Well, on average, in the basket of the currencies we looked at, which is about 6 or 7 currencies, they strengthened about 7.5%, 7.5 to 8%,
right,
versus the dollar. Well, if you look at today, under the same pretense that they're growing credit and they're bottoming, it's only strengthened 1.8%. So the currencies are essentially flat, and the currencies are really not saying that that China is picking up, and that's one of the things that we figured out. We owned emerging markets, and we realized, wait a minute, we might be wrong here because the dollar is not going down. Under the assumption that the Fed's walking back interest rates to bring on QE4, China's stimulating, the data's going to bottom in China, you should see the dollar down significantly, and the dollar hasn't budged. So for us to really turn more positive on emerging markets, you need to see the dollar really weaken versus some of these emerging market currencies, and it hasn't happened yet. So that we think it's primarily because they haven't been able to expand their credit.
So I'd like to ask you 2 questions here specifically about this. So one, you made a fascinating point here. China credit growth's gone from 4 trillion to 34 trillion. And really it's the year-over-year growth rate in that credit expansion which is the most important to the dynamic of the market. You know, how fast on a year-over-year basis are they increasing or decreasing that credit? Is there a limit to China's creation ability? You know, they have a very different economy than we do. They don't, you know, it's a state-run economy, so in a lot of cases they don't have the constraints on debt and funding that we have here in the United States. You know, is there a limit to their credit creation ability? And even assuming there isn't a limit, is there a limit economically that they could reach where it actually has a negative effect on their economy rather than a positive?
Yeah, it's a good question. So we think that there's definitely a limit. The Chinese overall are very, very good at controlling their economy and at pulling levers. The issue is each time you pull the lever, it becomes less effective. So what we think is happening right now is you should see, so based on some of the leading indicators, so for example, the Chinese reserve rate requirements for the banks have been cut significantly. So historically, when they cut these reserve requirements, the triple R cuts, you see lending pick up materially.
Sure.
What's happening now is lending is not picking up. So even though they're doing the same things that they have in the past, you're not seeing it come through the economy, which to us ostensibly looks like there's an issue with the credit transmission mechanism that's going on in China, which would say that they may be in the period where they're not able to expand it because they basically hit their limits. And what's interesting is a lot of some of these local governments also are barely have enough cash flow to finance the interest payments. So from a credit perspective, we think China right now is not in a great position to expand it and really drive global growth. Now that being said, internally in China, the optimism of potentially trade war and then also the tax cuts for corporation is really juicing the PMI numbers and also the equities, right. And that could carry through into the internal Chinese economy and make this sort of attractive there. But for the broad emerging market space where China is really the driver of all these guys, it's tough to see. And you're also seeing it right now in the PMI data of all these countries. They're all citing weakness in the most recent PMI to China, where China is actually having a material pickup in the PMI. So right now it's really expectations versus sort of the hard data
right.
that we're seeing on the ground. But you know, that could change. The Chinese are very good at figuring out how to fool you and how to expand things that you don't see, which happened to a lot of people in 2015-16 when they started borrowing on the local governments. But I think we're probably much closer to a point where they're going to have a tough time expanding credit.
So one more thing about emerging markets is that emerging markets, you know, and we can set China for aside just for a moment. Let's talk about the rest of the emerging markets for a moment. Most emerging markets are dependent upon the kind of industrialized economies they're mostly exporters, right? They export commodities, goods, et cetera, out of their country, and that's a big source of them, of their revenue. If the global economy is slowing down to a degree, and we're watching this globally, it hasn't completely washed up on the shores of the U.S. yet. We saw very high expectations for GDP growth this year and next year. But we are watching economic week. The IMF just came out yesterday, has reduced their estimates for growth for the third time in the last 6 months. There's an old saying that if the U.S. gets a cold, the emerging markets get a flu because of the relationship between emerging markets and the U.S. in terms of that trade relationship. To your point, we are also long emerging markets now that we bought back in the lows, because it was simply a trade base, and it's still a trade for us at the moment because it's working. But our optimism and outlook is really not as optimistic as what the Wall Street is, because of our expectations of a slowing emerging market environment because of economic growth. Does that make sense?
Yeah, that makes complete sense. And one of the things that's interesting is we can see ourselves getting really positive on emerging markets. I think towards the end of this year, Q4 is going to be a very, very, very big opportunity to own some of these things, because we think the U.S. slowdown, to your point, is going to also weigh on them. So the U.S. really slowing down and things potentially outside the rest of the world starting to pick up, that should really drive the dollar lower. And if the dollar really starts to get smoked, the emerging markets are the place you want to be from an asset allocation perspective. But right now, with the dollar where it is and some of the leading indicators we're looking at, it seems you're going to have a very, very good entry towards the back half of this year, and then that's probably going to be where you're going to want to own assets for probably 2 to 3 years, as the U.S. sort of gets through their slowdown economically, which could, to your point previously, last much longer than most people are expecting because of some of the tools we don't really have. And so emerging markets, while we're not very sanguine on them right now, could really create an opportunity going forward.
And let me translate that for Teddy real quick. That means emerging markets lower prices. That's what that says.
Over the next call it month and a half, are going to be very, very important for sort of an understanding of where the global economy is trending and asset prices. There's a huge liquidity pocket that's very similar to September, right before the October move last year. That's happening because of these buybacks that are blacked out. So if equities are able to maintain their strength throughout that period, then there might be an economic pickup that we're missing. So really, we let the markets sort of tell us what's going on, and right now we're trusting the bond markets, but we're open-minded in the sense that they also might be wrong and the equities might be right. But based on all of our leading indicators, how we view the world, our liquidity indicators, it's very difficult to be positive on equities here over the next 6 to 8 months. We've been pretty long bonds and lightened up that recently, but we think you're going to get a much better opportunity to own some of the U.S. and also the emerging market assets in about 8 months or so.
That's Teddy Vallee today. Great conversation. And there were so many topics I didn't get to talk to you about today: inverted yield curves and interest rates and bonds. So we got to do this again soon, so we can catch up on some of these other issues. There's so many good things to talk about. And talk about good things to talk about, you need to follow Teddy Vallee right here. Here's his Twitter address right below, right here at the bottom of the screen, at Teddy Vallee, so you get the spelling right. But follow him on Twitter. He's a great follow, super underfollowed. This guy's a brilliant guy and really great information you need to follow for him. Follow him on Twitter, and make sure and listen to this entire podcast at our website, realinvestmentadvice.com. Click on the YouTube channel. Watch all of this interview in its full entirety right there at our YouTube channel. Have a great day. We'll see you next time on the Lance Roberts Show podcast. We'll see you then.
All the things I could do if I had a little money. It's a rich man's world.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.